The RBI has come out with a credit policy. The market was expecting rate hike of between 25 to 50 basis point. The rate hike was expected more to stabilize rupee, which has moved from 63 to 73. This was expected more to convince debt investors that RBI is committed towards inflation targeting, and rising oil prices have created doubts in the minds of investors about inflation. However, between last credit policy and this credit policy, inflation has come down from almost 4.92% to 3.69%. Even with depreciation of rupee and rising oil prices, the inflation is not expected to go up by more than 35 basis points. The repo rate is 6.5%, and RBI expects 4.8% inflation in first quarter FY 2020. So there is almost 170 basis point pickup between repo rate and expected inflation in first quarter FY 20, which RBI found adequate enough not to raise repo rate. The market's expectation was hike. The RBI kept rates unchanged. So there is a little bit of disappointment in the market about RBI not hiking interest rate. Today, post credit policy, we saw rupee moving from 73.50 to 74.12 as we speak. We also saw equity market correcting by almost 300 points over the last half an hour post announcement. We saw little drop in 10-year yield from 8.15 to 8.07. My feeling is that this credit policy has brought the dilemma of RBI. On one side, constitutionally, they are mandated to manage inflation on a flexible targeting basis at 4% level, plus or minus 2%. On the other side, market expects RBI to manage currency whenever it is depreciating or appreciating. They also expect RBI to manage banking system stability. They also expect RBI to support growth whenever it is weakening or control growth whenever it is overheating. And more importantly, they also expect RBI to manage government's borrowing program. The market's expectation from RBI is to manage conflicting objectives, and RBI on one side is having dilemma because constitutionally they are mandated to manage only inflation, but on the other hand they also have to manage other conflicting objectives. By changing the stance, RBI has tried to bridge the divide between this dilemma. They have kept repo rate unchanged, but they have changed the monetary policy stance from being neutral to calibrated tightening. In neutral stance, RBI could have cut interest rates, raised interest rates, or kept interest rates stable. But in calibrated tightening, either they can keep interest rates stable, or they have to raise. Now, this change in stance is a bridge in the dilemma between inflation targeting versus other objectives from currency all the way to growth. The first quarter FY 2020 inflation target has been reduced to 4.8% from 5%. And despite that reduction in inflation, they have changed the stance from being neutral to being calibrated tightening. This juxtaposes the dilemma which RBI has to bridge while doing the job of constitutional mandate of inflation targeting and also managing other conflicting objectives from growth to currency. The reaction of equity market and currency market both was probably related to disappointment of not having as much hike as expected, in fact no hike compared to hike expected. But over next 2-3 days, markets will mull over the dilemma faced by RBI and the action taken by the RBI. They will also take comfort from the voluntary retention scheme introduced in the credit policy, which allows a debt FII to take any maturity of investment as long as they keep the money in India. Market will also take the comfort from RBI's commitment to provide liquidity and ensure that there is no undue volatility in Indian rupee market, in Indian FX market. Combination of all these things will kind of soothe the nerves of the jittery investors, and that should bode well for the fixed income and currency market in the days to come. As of today, clearly our fate seems to be tied with the oil prices. The sudden spike in oil above $80 a barrel has caught both debt and equity markets by a surprise, and higher oil prices as they threaten to go to triple digit is casting shadow in the minds of investors. If we see oil prices coming down, it will help currency rates as well as equities. But if oil continues to climb further, it will probably continue to have detrimental effect on equity, currency and the debt market.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.